One of the most significant international tax developments that were introduced by the Finance Act 2026 is the expanded definition of royalties and the definition of management and professional fees under the Income Tax Act. Traditionally, royalties covered payments relating to intellectual property and certain proprietary information. However, in December 2024, Kenya expanded this definition to include payments which are made for the use of or the right to use software, whether proprietary or off-the-shelf. This brought a wide range of software-related payments into the royalty net, including license fees, development fees, training fees, and management fees, as well as support fees. The Finance Act 2026 has now gone a step further by introducing payments made for the right to use or for the use of proprietary digital card payment networks or platforms. This means that fees which are paid to access, participate, or usage rights in these systems are now treated as royalties, regardless of whether they are described as service fees, transaction fees, network access fees, assessment fees, processing fees, or similar charges. Further, the Finance Act 2026 has expanded the definition of management or professional fees to specifically include interchange fees and merchant discount fees. These two expanded definitions have broadened the payments which could potentially be subject to withholding tax in Kenya. When taken together, these amendments signal Kenya's intention to bring a larger portion of digital economy and payment-related transactions within its tax net. As a result, businesses will need to reassess the characterization of cross-border payments, their withholding tax obligation, and any available treaty relief within Kenya's double taxation network. Potentially, yes. Many Kenya double taxation agreements contain narrower definitions of royalties and fees for technical, management, or professional services than the definitions that are found within the domestic law. In some treaties, management or professional fees are not dealt under a separate article, and instead they are treated as business profits. As a result, many Kenyan treaties do not expressly contemplate digital payment network fees as royalties. Similarly, where a treaty does not contain a specific article dealing with management or professional fees, these payments will generally only be taxable in Kenya if the non-resident recipient has a permanent establishment in Kenya. This creates the possibility of different outcomes under Kenya's domestic law as well as under the applicable double taxation treaty. In principle, where a valid double taxation agreement applies and provides for a favorable treatment, the treaty should prevail. However, taxpayers must still satisfy Kenya's limitation of benefit provisions before they can access the treaty relief. Given these developments, businesses making payments relating to card networks, payment processing arrangements, interchange fees, merchant discount fees, and other digital payments services should undertake a careful treaty analysis to determine the appropriate tax treatment. To stay informed on this and the latest international tax developments, and to navigate the expanded royalty management fee rules and understand the impact on cross-border transactions and withholding tax obligations, join our annual Tax Connect from 28th to 31st July at Diamond Leisure Beach and Golf Resort, Diani. Reserve your slot today and stay ahead of Kenya's changing international tax landscape.